Very incremental changes in that statement. Were you expecting more than what they delivered?
No, I wasn't. I think with the strong growth numbers we received, the right place for them to make adjustments is exactly where they did. Reflected a little bit in cooling labor market conditions, reflect a little bit more progress on inflation, kind of pin down and nail down that balance of risks argument, because that's what the chair had said in front of Congress. So I think this was the right incremental move. I think the Fed feels that it's in a sweet spot right now, that the data's moving in its direction, so it's getting closer. It just needs a little bit more, and then that confidence, that nebulous confidence, may be there. So this is what we were expecting. We weren't expecting a big lean in either direction from the statement.
The market, as you know, Mike, has been looking for September and a baby step towards that. You and the team have been looking for December. What separates you at the moment, Michael? The data that backs up your view. What separates you from the rest of the street at the moment?
Well, I'd say we have less concern about downside risk to the economy. We certainly are watching for it and looking out for that we may be wrong on this view. But the economy grew at a pretty solid pace in the second quarter. And yes, things are moderating and cooling, but I still think that there's a lot of resilience to both the economy and labor markets. And we'll see. Maybe there's a little unevenness in this inflation story. But certainly a September cut has moved a lot closer to our baseline. So yeah, we're still in December, but we've got 2 employment reports and 2 inflation reports between now and then. Further progress in those 2 variables, a little bit weaker employment, kind of repeats of what we just saw in June inflation, that could easily put a cut on the table in September. So September can happen, but it may not.